everyone, I'm Krishna Karwa, a senior research analyst with iFAST Financial India Private Limited. In today's video, we will touch upon the nuances of a passive debt product from Axis AMC stable. Joining me on this call today is Mr. Shane Vaz, a senior product manager at Axis AMC. We look forward to his insights during the course of this discussion. So without further ado, hi Shane. At the outset, we are curious to know as to why this interesting passive debt investing is developing in India, and what is your take on how advisors and investors should be positioning this in their portfolios?
Hi Krishna, and thanks for having me on. It's not really a novel concept in the sense the wrapper has changed. We've been very accustomed as AMC providers and investors investing into target maturity strategies for a while now. So if you were to look at it in the earlier avatar, FMPs and fixed term plans, and even plans like dual advantage or capital protection schemes are basically what today's avatar of passive investing, as we call it, were. So in the earlier avatar, FMPs were very, very successful. A lot of the incumbents, including ourselves, had issued a lot of FMPs with a lot of success. And what passive investing has done is basically it has evolved the concept of FMPs. The drawback with FMPs basically was that it was illiquid, and in terms of exigencies, or if investors wanted opportunities to kind of exit, it wasn't there, because the nature of the product meant that you stay invested through the entire duration of the FMP. Hence the close-ended tag, as we used to call them. With the evolution of passives and ETFs, target maturity products have now got that added advantage of liquidity, which is really much needed, because if you look at it, look at things, the typical asset allocation from a debt perspective, typical investors would try and match their goals with their investment horizon. So target maturity products are ideal in that sense. Alternatively, many investors use a lot of these target maturity products to also manage their liquidity over periods of time. So say, for example, you have a 3-month liquidity or a 6-month liquidity. By virtue of using passive products like a target maturity product, you can easily enter and exit, as you wish. Now, another benefit is there is no exit load concept. Like, for example, in the ETF we are running, you can come as you please and go as you please. You can trade on the exchange. So there is no real exit load. It is only determined by the transaction costs that your broker would levy on you. So in a sense, it's a natural evolution that has happened, and it's a welcome evolution. And we at Axis, have taken that step forward.
And that's indeed heartening, to hear that there is a new trend, and one which can assume relevance for the advisor and investor fraternity alike, by virtue of this open-ended feature of essentially a close-ended fund.
Yeah. You put it very well. So that's exactly how I would basically pitch it to investors as well.
Sure. So moving on, let's get to the specifics. Now, Axis has a product, an ETF more specifically, which offered 50% exposure to AAA corporate bonds and 50% exposure to state development loans. And now the AMC is coming up with a product which is a FOF variant, or a fund of fund variant. Yeah. Can you take us through the features of both of these, as well as tentative figure on the expense ratio front as well?
Sure. So I had on your channel itself, we'd spoken about why the ETF makes a lot of sense. So just to recap, basically where we are in the cycle, right? if you were to look at a typical target maturity product, the objective is to kind of maximize your yield slash return, as you would term it, and try and build a portfolio of these target maturity products, again in line with your asset allocation, with a very low cost structure, right? So the ETF basically was structured around having an expense ratio of about 15 paisa, so 0.15%, and what it does is basically, like you pointed out, invests in the 5-year bucket between AAA bonds and SDLs. Now we work with NSE to kind of create this index, and the mandate was very clear. If you were to look at the 5-year curve, uh, given the normalization that has happened post February, or rather January, you've seen that the YTD, the 5-year space, has been the one area where yields have spiked very dramatically. This could be because of what happened in the previous cycle, where in 3 and 5 years, effectively saw the biggest gains. Basically, if you were to go back to 2018, you saw 3-year trading at about 875, and towards the end of January, early February, those rates were closer to 4%. Something similar happened in the 5 years as well. Now, typically, what happens is that because of this, we had a very steep yield curve, and that yield curve has begun to normalize. So we notice as of today, there has been a very gradual return to normalization in the 1 year, 3-year, 5-year space. The longer end of the curve has remained anchored. So in terms of getting back to a normal yield curve, we've got a fair guide path that so the RBI in part and the market participants are working towards, and this is happening very gradually. So we believe at this point in time, because of the yield curves moving up very dramatically, especially on the 5-year space, the 5-year makes a lot of sense. Why did we select a AAA and an SDL? Two reasons to it. First is that while the 5-year segment is benchmarked to the GSEC, you often tend to see AAA and SDLs move in a sort of disjointed manner in the relative context, which means to say that at some points in time you will see a AAA offering you a better yield, and the other time, as it is in today's market, SDLs are offering you a premium. So we do not want to be in a situation wherein running a pure SDL or a pure AAA would basically make this product uncompetitive. What we are offering investors today is a blended product that will work throughout the cycle, and that's what the objective is, right? To have a product that works through the entire 5-year cycle, and gives investors the opportunity to kind of participate as and when they believe it's the right opportunity for them. The fund of fund coming. I know this is a little longer answer, so give me some rope here. But the fund of fund basically is structured precisely because a lot of investors are not yet savvy enough to run ETFs as part of their portfolio. So in ETFs, there are logistical challenges about how you need a demat account, you need to trade on the exchanges, and if you want to trade with the AMC, you have to come in a very large basket. Case in point, in the ETF today, if you have to come directly trade with the Axis AMC, you would need to come in at around 2.6 or 2.7 crores, which is out of the realm for typical retail investors, and hence we thought that fund of fund structure will complement the ETF offering that we have. All said and done, for investors, the opportunity is the same. It is just how you prefer to participate in the story. So if you are comfortable, you are savvy with the way you deal with your investments, and you are okay, you have a demat account, the ETF is the best way to go about it. If you're a little more traditional in your approach to mutual funds, an FOF makes a lot of sense for it. Finally, in terms of expenses, the ETF is priced, like I mentioned to you, at 0.15%. The FOF will not have a significant markup to that. It is just so on the direct plan we envisage about 8 or 9 basis points incremental, and about 10 or 15 bips on the regular side. So your blended cost would come to about 30-35 bips on the regular plan. That's what we envisage at the moment. So yeah.
Okay, so there you go, the benefit of low cost investing, some high quality debt instruments, and the convenience of SIPs also available for fund of fund investors.
Yeah.
Okay, so another case in point here is the underlying benchmarks. Now, these funds are passive in nature. Now, so, can you talk us through how these benchmarks for AAA corporate bonds and STLs constituted, and how often would they be tweaked over a period of time?
Yeah, sure. So the way it's structured is basically this is a custom benchmark. So we worked with NSE to create this benchmark, and the objective is to identify very liquid securities. So if you were to look at the construct, you've got the top 6 corporate issuers by total outstanding on the corporate bond side, which account for 50%. And you've got the top 6 issuers on the SDL side, again 50%. What we've done is we don't really want to take a directional view on one bond versus another, so we've kind of equated that both segments. Now, the way it is structured, we do not believe that it would change very much, because if you were to look at the current outstandings, these are very large issuances that so someone like the likes of HDFC or an NTPC or some of these very large Exim as a borrower, or NABARD as a borrower, very large issuers. So we do not believe that in the same maturity bucket, which is April 2026, we would have too many very large issuances as we progress along. So what the objective here about the index is to minimize the churn. So as you keep churning your portfolio, there are transaction costs that get involved, and the objective is to minimize the cost and try and give a more structured, more consistent return over the life cycle of the fund. So NSE has got provisions in place in the event of, say, a default or a downgrade of any of these securities. So there are SEBI provisions around it. There are the index methodology also has some provisions around it. They're available on our website. Investors can go and view them. But in normal courses of business, we do not anticipate too much churn in the portfolio.
Sure. So, while we also understand that the corporate debt exposure in the context of both the FOF and the ETF is AAA in nature, in the past, we've come across a lot of instances where some of the marquee names in the industry have defaulted. And from whatever we know of the ground reality, a lot of advisors and investors per se are not so keen on once again going all out and investing in corporate bonds. So is that really a cause of concern in the context of these two funds?
Yeah. So yeah, so you should what the way I would put it is you have to look at the ground realities of what happened, when say a DHFL was downgraded and defaulted. The impact there was a clear case of malfeasance. There was a clear case of so the courts adjudicated towards a variety of misappropriations and all of those. Also, you have to understand at that point the credit cycle was very weak. Economy was there was stagnation in the economy. The corporate environment was quite weak, and because of that, you had instances around the IFAST default, there was contagion concerns in the NBFC pack post Divan. So a lot of that happened during the 2018-2019 cycle. Even in the past, if you were to look at historical ones in 2014, when some of the other funds had defaults, there were clear cases of corporate abnormalities, or there was a macroeconomic condition that have effectively led to companies failing in their ability to kind of repay their debts. Fast forward to today, what are you seeing on the ground? Corporate earnings are very strong. There is a massive deleveraging that is happening across previously very stressed sectors like steel. You have some degree of telecom. You've got a lot of these stressed sectors. The MSME space is improving. They're borrowing again. You've got high quality issuers now coming again into the fold because they are now into a fresh capex cycle. The economy is growing. And a lot of this is pushing levers in the economy, which point to a very sustained recovery. What happens in times of recovery? In times of recoveries, you see credit profiles improve markedly. You've also seen that while corporates borrow, they borrow more prudently, more frugally. And the learnings from on the banking side have also been immense. You've just come up. Banks are now coming out of a cycle over the last 5 or 7 years, wherein they've handled and grappled with a huge NPMS. They've understood. They've sharpened their borrowing focus, and a lot of these factors make the credit environment in the country significantly stronger than what it was in the preceding 5 years or even in the preceding 10 years. What you've also noticed is that because of regulations surrounding a lot of corporate borrowing, you are not seeing the borrowers how would I put it, the ill-fated borrowers coming back to the market in a new avatar. SEBI has made sure that a lot of these guys have been put in their place. And what this points to is that today the environment is much more safe, or it's relatively safer than what it was, say, maybe 5 years back. Of course, there could always be an instance. We don't know what happens in the future. So we've also taken a lot of safeguards. What we are offering investors today is the largest issuers, right? So if you were to look at the mix, 1 out of those 6 issuers is a non-government issuer, which is HDFC. The rest all are backed by the government, right? So in effect, it gives us a lot more confidence to go out and lend to a lot of these companies. We hold a lot of these securities in our active book as well. So which gives us that comfort and confidence to say that we are offering you a product which has a lot more credit cushion than what you would typically see in some of our other products, like say a credit risk or a strategic bond fund. So in essence, we are a little less concerned about credit risk. What investors should look for in this type of a product would be more of, say, an interest rate risk or a duration risk that might play out, given that we anticipate rates to rise over the next couple of years. So those are the 2 key risks that I would like to highlight in a product like this. But for investors who've got a 5-year horizon, because you would typically be holding this to maturity, you are a little less less impacted by an interest rate or a duration risk.
True. And in fact, that's a very important message for investors out there, that corporate bonds, especially the ones in underlying benchmarks like these, are absolutely safe, and you're good to go with them.
Yeah. We never use the word safe. So we say they're relatively safe.
Okay.
Yeah. So, I mean, there is always that degree of caution that we do advise investors, because these are, at the end of the day, market-linked securities. So, yeah.
So in fact, that was a comprehensive explanation even on the interest rate risk bit. But if one were to hold till maturity, then it wouldn't be such a big problem.
Yes, precisely. So, because just like an FMP of the past, the objective here is to hold to maturity. So, all the bonds that we have in our portfolio and that ones that we will buy are typically securities that would have a maturity closer to the maturity of the scheme. So, what we try to do is basically maturity match the entire portfolio to minimize any reinvestment risk. At the same time, what we're trying to do is build a very competitive portfolio over the entire life cycle of the product. So as investors, the primary goal of the investor who's coming to participate in a product like this would be to kind of maturity match and goal match your investment in this fund.
And yes, between these couple of elements, the state development loans and corporate bonds, we will of course see changes in market values, and in the overall portfolio as well, their weights may differ from the originally envisaged 50-50 mark. So how
Yes.
often will Axis be rebalancing exposures to these?
Yeah. The objective of the index is to rebalance them periodically. The way it is structured is we would rebalance either half yearly or annually, depending on the quantum of variations. Where there is also a liquidity filter to it. So basis that in the event that there is a very large issuance or very large and liquid instrument that comes into the to the fold, then of course we will kind of rebalance the portfolio in totality. Yeah. But
Okay,
we do not envisage
the
this
cost
happening
bit
too often.
will also be taken care of to ensure that NAVs are not hit too badly because of periodic changes.
I'm sorry, I didn't get that.
Okay, so there won't be too frequent instances of rebalancing,
Yes.
which could entail high impact cost.
Correct. Exactly.
Okay,
Exactly.
okay. And this one advantage that stands out in passive debt investing is that you can limit credit risk and also tackle interest rate risk. Now, the other impact a lot of investors have, especially those who want to park money for, say, the 5-year period which you referred to. Yields can one expect from this corporate bond and combination as of now?
Sorry, Krishna, I lost you.
Oh, again, okay. So you did elaborate on how one can tackle both credit and interest rate risks. What kind of yields can one look forward to, especially when you know that a time horizon to maturity is defined?
Yeah. So we can't talk about yields per se on the fund itself. But if you were to look at typical bonds that trade today, on the 4.5 to 5 year segment, typical corporate bonds would trade at anywhere around 560 to 575, and SDLs would trade closer to around 6% as we stand. So I mean, uh, obviously the portfolio as it kind of gets built, you would get a fair idea of what the YTMs would look like, and we disclose that as part of our monthly reports and our fact sheets. So ballpark, if you were to look at what the current yields are in the market, they work out closer to around 575 to all the way to 6%.
Okay, and then of course, depending on market movements, the yields over a period of time would change.
Yes, of course.
And if one were to invest in a staggered manner, either using the buying on dip strategy through the ETF, the SIP route in case of FOF, one would derive the pro rata yield. depending on the quantum and the yield at that point.
Correct. And that is one of the hallmarks of the FOF. Investors can look to start systematic transactions into a fund like this, simply because in an ETF that becomes a little more difficult because there are manual interventions that are put in place. A fund of fund effectively gives you all the liberties that you would be that you would have in a traditional product, like some of the active funds that we run. But by virtue of it looking to invest, the structure is such that the entire most of the proceeds, sans some element for liquidity provisions, are invested in the ETF itself, and ETF in turn kind of buys all of the securities that are as part of the index, or tries to replicate the index as best as it can. So the fund manager takes a lot of this action on your behalf by virtue of the fund of fund. And for investors who are looking at systematic investment, the fund of fund is an ideal mechanism to kind of participate in the story.
And once again out there, if investors want to take advantage of interest rates moving up, which will also imply that yields get higher, they have the flexibility to do that.
Yes.
In both
one thing I would like to highlight to your audience here is that one differentiating factor of a fund of fund vis-a-vis the ETF is the settlement cycle. So if you were to look at when you were to sell an ETF, because of the exchange settlement cycle, you would get your money on a T+2 basis. In a fund of fund, what we've tried to do is, because of the settlement cycle there as well, we've tried to maintain that at T+2 as well. And this is a little different from a traditional debt product, wherein you would get your money back the next day. In an ETF and a fund of fund, the cycle is T+2, and that is what retail investors should look at and consider that while participating in the fund. Furthermore, the fund of fund also has an exit route, while the ETF does not. So it's very important that you plan your exits very well as well.
And also the fact that the taxation benefit also helps maximize their in-hand return after a 5-year period.
So taxation is effectively is at par with a traditional debt mutual fund. So you get debt taxation and you get the benefit of indexation if you stay beyond 3 years. That is the same for both the ETF as well as the debt fund of fund.
Absolutely, and in fact, all the features of the products quite comprehensively, and I'm sure viewers will have a fair bit of an idea as to how both of them work.
Yes.
So, and passive debt investing is clearly here to stay, and a differentiated product like this can be a meaningful addition to one's portfolio as well. So, Shane, any additional thoughts from your side in the context of theme, or more specifically the products that we...
Yeah. So if you were to look at just final comments to summarize, the AAA bond fund of fund is a strategy that we've been pushing to clients ever since we launched the ETF in May. And the fund of fund is just another manner in which you can participate in the story. The offering, in a sense, is right from a market timing perspective because of the way rates have moved. We anticipate this opportunity to stay for the foreseeable future, and for investors who are looking to invest over over a 5-year investment horizon, this makes for an ideal product. Given the steepness in the yield curve, we are as a fund house underweight on the 1 to 3 year segment, and we believe that even if investors are looking at a shorter tenure, maybe say 3 years, for example, by virtue of you holding a longer maturity product like the AAA bond ETF, we anticipate that you would be better off in the current context. We've got a scenario analysis that we've put out in our marketing collateral, and which basically points to this fact. And we believe that the 5-year is an ideal situation, or is the ideal investment solution for investors looking at a debt portfolio with a meaningful time frame.
Absolutely. And these differences in steepness of the yield curve is one that you correctly attributed to be taken advantage of. And a product of this nature which offers that certainty of yield and the advantage to cash in on opportunities in terms of changes in the curve is also something that should strike the chord with a lot of people. So, all right, we would like to thank you and Access AMC for taking out time joining us today and touching upon a couple of things. And we hope find all the points that we discussed quite helpful and meaningful. So on that note, we shall wrap up this video. Thank you everyone for tuning in and watching. Until next time, take care, stay safe and happy investing. Goodbye.